Well, I mean, it was not a great day for the bulls with the GDP numbers, as you said, but that's backward looking. That said, 32.9% decline is huge, and the consumption expenditures being down 35% also is worrisome. It's really startling, the numbers that we're seeing. I'm more concerned, Sarah, about the initial claims, because we're now up 2 weeks in a row in initial claims. I look at the 4-week moving average. If we go up for the 4 straight weeks, then we're going to have to probably revise the recovery assumptions, but we're still going to see a recovery. It's an uneven economy. It's a terrible labor market, but there are pockets in the economy that are actually doing quite well. Housing, auto, even retail sales, e-commerce. Look at PayPal. They had daily average users up 40%. And look at UPS, business to consumer. They delivered 21 million packages each day in the quarter. I mean, it's really crazy. So there are pockets that are doing well. There are pockets that are not doing well. This is why we will get the fiscal package from Congress is it days, is it weeks, but it's coming.
Mike, we're waiting for this slew of big tech earnings after the close. I guess the setup not quite as hard as it was for Microsoft 10 days or so ago, but they're increasing the pressure on themselves in today's session.
A little bit, yeah, Wolf. I mean, as a group, they've really done nothing for 3 weeks. They're all down, 4 to 7% off their recent highs. There has been a general, and not just in tech, a general sell the news instinct in terms of individual stocks reporting, individual companies reporting. Hard to say that all four, though, are going to have some kind of unified response, and therefore it's going to be a market-wide kind of verdict on whether these guys have gone too far. In general, they've done better when they were much more just abstractions. They were just claims on long-term cash flows, and they were, beneficiaries of this environment as opposed to individual companies that have to kind of show their work every 3 months. But I don't think there's necessarily an edge in here. I think the big thing is that when the macro gets scary, as it sort of did this morning with the claims numbers, the market goes back to these names, and that's why they lifted the overall indexes from the morning lows.
Let's pivot and talk about banks. Tough day for the bank sector. Simple reason, cyclicals and value names are suffering off the back of weak economic data, and with it, bond yields falling, which particularly, of course, hurts the banks, as we all know. The 10-year down at 0.54%, and the interest rate sensitive names within the group, like Wells Fargo, suffering more than the investment banks like Goldman Sachs. The KBW Banks Index is down about 2.5%. Certainly, therefore, a bad day for the banks. That said, this past month or so has been range-bound, really, for the sector. While it's absolutely true that they continually fail to break out to the upside, they're not really breaking down either. Whereas moves this week in European banks are more stark to the downside. Barclays, Deutsche Bank, BNP, Lloyds, for example, all have reported in the last couple of days. They're down closer to 10% in just the last 3 or 4 trading days, compared to the U.S. banks, which today are really just giving up gains earlier this week. The U.S. investment banks, by the way, the clear winners when it comes to Q2 trading revenues. Most of those European banks coming in at sort of plus 40, plus 50, plus 60% year over year, compared to some of the U.S. investment banks that were up over 100% year over year. Steph, I guess we're just getting another reminder of how many hurdles the banks have to get over. Whenever they find 2 or 3 days of impetus, it gets undone quite quickly.
I know, and range-bound is almost like a victory these days, right? But
Exactly.
But you're right in terms of investment. The investment banks are they're holding in better, and they're massively outperforming the money center banks, and that's because they did have great quarters, right? And their stocks are still cheap. They don't have as high dividends, but I think that you're going to see more dividend growth from a Morgan Stanley, maybe not Goldman Sachs. I wouldn't touch the European banks, Wilf. I mean, their capital levels are not nearly what the U.S. banks are, and I think there's market share to be had, and I think that's what has been happening for some of the money center banks. But you're right. I mean, look, this is a function of interest rates and a flat yield curve. It's going to be very tough. This is why I own special situation stories. Wells Fargo with the turnaround, Morgan Stanley with E-Trade, and Bank of America are doing a very good job on their responsible growth strategy. So I only own those 3. I also own American Express. So all these things are down and out, but I do think that into a recovery into next year, they should do better next year.